So, you want to invest in the stock market. You've got some money saved and you're ready to put it to work for you. Overall, that's a wise decision. Over most time frames, the stock market has delivered positive returns and rewarded investors handsomely, funding many a retirement. But before you start investing, there's one big risk you need to be aware of: scams. Stock market scams can be dangerous because they can cause financial losses that can deplete your hard-earned savings. According to the FTC, financial fraud cost American consumers $8.8 billion in 2022. It's sure to cause more losses in 2023. There are countless duplicitous stock promoters out there looking to capitalize on the desperation of regular people who are just looking to make a buck. With that in mind, here are 6 stock market scams to be aware of in 2023. Number 6, crypto scams. Now, I know what you're thinking. This is a video about stock market scams, right? What does crypto have to do with this? As it turns out, it has a lot to do with it. A lot of crypto investments are listed on the stock market. Examples include mining companies and crypto exchange-traded funds that exist only to buy and sell crypto. Now, I'm not exactly a crypto perma-bear who thinks that Bitcoin is going to zero or anything like that. I don't have any crypto holdings, but I think essentially Bitcoin and other cryptocurrencies are impossible to analyze and that buying into them is kind of a leap of faith. However, there is at least one known scam involving crypto investments on the stock market, and that is excessively high fees charged on crypto exchange-traded funds. A crypto exchange-traded fund is a fund that will invest in a cryptocurrency, let's say Bitcoin, and allow you to buy it easily and conveniently on the stock market. This way, you don't need to worry about losing your wallet password or anything like that. It seems convenient, but the only problem is that these funds often charge fees as high as 2%. In fact, when doing research for this video, I found one that charged exactly that fee. This is an excessively high fee because these funds don't do anything that you can't already do yourself just by holding Bitcoin or another cryptocurrency, and it's a kind of ripoff or scam when viewed in that light. Again, this is not to say that you should never invest in cryptocurrency. I'm pretty much agnostic on the topic, but if you do invest in it, you might want to avoid excessively priced crypto ETFs because they tend to be poor investments with excessively high fees. Number 5, excessive fees. Related to the previous point is the phenomenon of excessive fees on funds in general. Sometimes companies promoting basically legitimate investment products will charge excessively high fees for their services. In this case, what you have is perhaps more accurately termed a ripoff rather than a traditional scam. You are getting a legitimate service, investment management, but you're just paying way too much money for it. A great example of this is hedge funds' 2 and 20 management fee structure. Under this structure, you pay a 2% fee every year on the assets under management, whether they perform well or poorly. For example, if they go down 50%, it doesn't matter. The fund manager is still collecting that 2%. On top of that, if the fund outperforms a given benchmark, you have to pay another 20% on the amount of return that is in excess of that benchmark's return. Over a very long period of time, these fees can really eat into your returns, and what's worse, the fund managers who charge these fees are not even managing to do anything for you that an average index fund can't. In fact, they're delivering much worse returns for investors than index funds on average. You can go out any day of the week and buy the entire S&P 500 for a fee as little as 0.04%. Hedge funds, on the other hand, if you have enough money to invest in them, will charge you 2% at minimum most of the time. And there's proof that these funds are underperforming. In 2008, Warren Buffett made a $1 million bet with a well-known hedge fund manager, betting that this hedge fund manager's collection of funds that he handpicked would not be able to beat the S&P 500. Over a period of 10 years, the S&P 500 outperformed the collection of hedge funds, by a lot in fact, and Warren Buffett ultimately won the bet. Number 4, boiler room scams. A boiler room scam is a type of fraud where scammers call potential victims and convince them to invest in something that will promise very high returns. Someone running such a scam will usually dupe an investor into buying worthless shares of a company at inflated prices that are impossible to sell. If you've ever watched the movie Wolf of Wall Street, this is the kind of scam that its main character, Jordan Belfort, was running. Number 3, Ponzi schemes. A Ponzi scheme is an investment scheme somewhat similar to a pyramid scheme, in which someone will claim to be running an investment fund, but will actually just be paying off the earlier investments in the fund by using the funds contributed by newer investors. Obviously, since there is no source of actual returns here, the scheme will collapse sooner or later. A well-known example of this was Bernie Madoff's scheme, which cost American charities and other investors billions of dollars. Ponzi schemes are named after the Italian-American fraudster Charles Ponzi, who created an early version of the scheme, though not the original one. Ponzi's original idea involved exchanging postal stamps for different prices in different countries, and it might have actually made money if he'd implemented it, but unfortunately he just ended up paying off his original investors with newer investors' money and was eventually busted for fraud. Number 2, the pump and dump scheme. This is a scheme that involves smaller stocks typically and can involve Discord pump rooms and other such social media activities. In a prototypical pump and dump scheme, someone will pick a small cap stock or even found a company just to list it on the stock market and inflate its price. The person will buy shares in the stock or maybe just list the stock themselves. They'll try to get the word out on social media, maybe even sending out press releases to the traditional media or using paid advertising. This investor's own buying will get some price momentum going initially because buying a stock tends to drive up its price. Then all the social media publicity about the rising price will get other investors buying and pump the price even further. Unfortunately, what tends to happen at the end is that the scammer, if he can realize a higher stock price, will then sell, i.e. dump the shares on all of the unsuspecting investors who bought in, and they'll end up seeing their shares go down in price and they'll never be able to sell or get their money out at an acceptable price. Number 1, accounting fraud. I put this scam in first place because it's one of the most deceptive scams that's the hardest to spot, and also this can be done by entirely legitimate companies. Accounting fraud is when the management of a company will put out fraudulent financial statements in order to make their company look like it's doing better than it really is. Investors value stocks largely by their earnings results, and the earnings that are reported to investors, they're a product of accounting. It's numbers that human beings have to calculate and present in an acceptable way. Now, normally, companies will be relatively honest about the numbers they put out, but sometimes they can outright fabricate the numbers, and strangely enough, the ways in which they do this are not always totally illegal. A classic example of accounting fraud is the Enron scheme, in which one of America's biggest companies used special purpose vehicles to take bad debts off its balance sheet, thus making its financial position look a lot better than it really was. Because Enron was reporting good earnings, its stock kept going up, but eventually some people spotted the fraud, and when it became common knowledge, the stock collapsed, and investors lost their money. Conclusion. So, having looked at 6 stock market scams that you need to watch out for, what's an investor to do? Should you stay away from stocks entirely? Stick to index funds? Maybe hide under a rock until all the scammers are rooted out of the market? I'll give you one piece of advice. In general, sticking to index funds is a good approach for the average investor. These funds, when offered by reputable sponsors like BlackRock or Vanguard, spare you the fate of paying excessive fees, which is one of the scams that was mentioned in this video. They also tend to outperform most active investors over long periods of time. If you do intend to get into individual stocks, it pays to be skeptical about any crazy claims that are being presented to you. For example, 50% returns each year or doubling your money in a short period of time. And also avoid investments that seem to be playing into a craze or a fad. After the fad bubble pops, those stocks tend to go down in price dramatically. As long as there have been investors, there have been unscrupulous promoters looking to take advantage of them. They'll be with us forever, but if you know how to spot them, you can go a long way in protecting yourself and your money.